Good morning, everyone. Firstly, thanks to Bella, Steve, and the whole team at Wholesale Investor for inviting us to do this panel once again this year. It sounds like it's been a great morning so far, so looking forward to hearing from our experts this morning on the panel. We'll start with some introductions. Firstly, my name's Kate Galpin. I'm a senior manager in listings at ASX. So basically, my role involves working with companies to consider and take on the pathway to an IPO, focusing mostly with growth companies in the tech and healthcare sectors. So to start with, let's work along the panel. Guys, if you could just introduce yourselves, your fund, and your investment focus, that'd be great. Stephen, should we start with you?
All right, thanks, Kate. Hi, everyone. My name is Stephen Xu, co-founder and CEO of MP Capital. So we are, investment firm focusing investment in North America and APAC region, which we have two major funds, early stage and growth stage. So early stage, quite industry agnostic. Growth stage, we allocate 50% capital to support our early invested companies, and then the rest of capital deployed to the sector. We've done the research from our research team. So currently, early stage, we quite focus on AI, sustainability, and SaaS, enterprise to be SaaS area. And the growth, I think, is aligned. The journey is more support on that. Have a strong growth opportunity, AI plus, and the climate tech and the renewable energy area. Thank you.
I'm Karen Chan. I'm portfolio manager with Perennial Private Investments. We manage $700 million for our investors, focus on later stage growing private companies, and we also invest in pre-IPOs as well as IPOs and placements. We are a sector agnostic fund, but we are looking for high growth companies, so generally they would be more technology enabled.
Hello again, everybody. Hashan De Silva, Managing Partner at KPRX. We're a healthcare VC. We do biotech, medtech, medical devices. We're a later stage investor than your typical healthcare VC. So we focus on drug companies at human trial stages, medical device companies closer to regulatory approval.
I'm Raj Gupta from Alium Capital. We're a firm that is 9 years old. We focus largely on mid to late stage technology innovation companies in Australia and New Zealand. Occasionally, we will do some early stage. Since inception, we've returned about 22%, and that's been achieved through having invested in 70 companies. Whilst liquidity and outcomes is always a focus for us, it's in vogue now, and we've had about 35 exits since inception.
Great, thanks everyone. So we'll kick off the panel by diving into some of the current market landscape and dynamics in the macro environment. We're going to focus on the private markets in this panel, but just to give a public markets perspective, last year was a year of all-time highs, and ASX was no exception in that. Obviously, some very near-term volatility this week, but there's been all-time highs as well, from the beginning of this year. In terms of an IPO perspective, we're definitely seeing green shoots and momentum increasing. So basically, as of when Guzman and Gomez tested the market for the first time, mid last year, and the performance that they've seen through there, we've seen an uplift in interest. Digico raising the $2 billion REIT for the data center was the largest raise on ASX since 2018. And we've welcomed Chemist Warehouse through the merger with Sigma Healthcare this month. We're forming a $32 billion market cap company. And obviously last week, Goodman raising $4 billion in the secondary market, which is the second largest deal in ASX history. So we're certainly seeing some green shoots there. In terms of the private markets, and Karen, I'll go to you first. What are you seeing in terms of market dynamics, and what sentiment are you feeling in the market as a whole?
I think in terms of the sentiment, we're seeing a lot more optimism this year, a lot more return to normalcy, and also sprinkled with a measured approach, because investors actually are very much focused on also returning capital to their investors. And because we are much more measured, we're not meeting the valuation demands of our founders that we meet. So there's definitely a closing of the gap between founders and investors. And so I think we're expecting to see a lot more activity, whether it's in investment or divestments as well. And that could be through M&A and IPO. So I guess with also the regulatory landscape, I think that's also something that we're keeping in mind. We're also seeing ASIC, as you would have seen in the news today, also are doing a bit of a review on the private markets. But one of the key messages is that the investment ecosystem is very healthy if you've got both the public and private markets firing. And on the private side, investors are still very keen to put money to work.
Raj, Hashan, Stephen, anything else to add from your perspectives?
I guess in healthcare, I mean, like I said before, it's not great. Maybe an idiosyncratic thing with healthcare, what I've noticed is sometimes I meet a company, I might love what they're doing, but they need 20 million or 10 million to get to their next value inflection point. And I look at them and I say, I can't fund your trial. I got to syndicate that with somebody else, but there is nobody else to syndicate with. So if I do all of this work and say, or I'm going to commit $2.5 million to your company, you've got to go out and find the rest of it yourself. If there is no one else to find it from, I've just wasted a whole lot of time. And so there's a bit of this kind of chicken and egg thing with the moment where companies are like, well, if you're the lead investor, we can go find somebody else. But then I'm sitting there going, well, I don't want to dedicate all that time to doing all the work and then not being able to fill the rest of their round. That might be idiosyncratic to healthcare because of the lack of capital in the private space. But yeah, I don't know, Raj, are you seeing something similar?
From an observation standpoint in tech and innovation, in calendar 2021, a company would come to you, you'd open the first page, and it would talk about total addressable market, which TAM for me is actually totally absurd metrics. But the point being now, when a company comes to you, the first page is generally about their pathway to liquidity and exit. So that is a paradigm shift. In 2021, it was all about growth at all costs, grow at 100%, we'll pay you a high multiple. Now, growth of 30% is exceptional, and you need that conversion from revenue to high gross margin to good EBITDA margin and net profit, and what is the company worth, and how do you realize or crystallize value as an investor through either appointing an advisor or assisting the company to get an advisor to get a strategic outcome in M&A, or alternatively going to Kate and saying, Kate, this company should do an IPO, can you help them? So liquidity is the biggest change that we're noticing, not only in what we do, but also the companies themselves. It's a critical outcome.
Yeah, I think it's, to me, what we see is cautiously recovery. So I think the investors still remain selective. So still, focus on more strong fundamentals rather than pure growth. So I think the founders need to really prepare to demonstrate you have a capital, efficiency, you have a strong fundamental and the path to profitability, and then lead to what's your kind of like multiple axis strategy. I think that will be really important for your raising, capital or kind of for support your growth.
That's great, thanks. Stephen, I'll stay with you. So INP Capital obviously invest globally, so interested in your perspectives, from more of a global sense, and then also how does Australia compare and sit within the global piece?
Yeah, I think it's, so we invest more in North America and APAC, so much on the Europe. So what I see only on these two large regions. So North America is still dominating the venture capital, especially in that AI and deep tech. And the US, what we see is still leading in that later stage capital investment. And more Canada is more like a research driven, the capital investment on clean tech or other areas. Asia Pacific, we see is more like commercialization driven. So the startups kind of scale faster, especially in China, Southeast Asia. So the capital more focus on your market traction or revenue growth rather than long-term R&D investment. I think Australia kind of sit in the middle. So it has strong innovation, especially in that, biotech, agri-tech, renewables, that actually provides strong foundations. But what we see is it's been struggles on later stage capital constraints. So that is really forced companies to seek expansion overseas or early exit. So, and also the raising or the financing timeline is still longer than usual. So I think founders, although the environment is improved compared to last year, but still take a longer period than what we think, back in 2020 or 2021. So that is, I think founders need to be prepared for that.
Guys, any other insights from your portfolio companies, how they compare to global peers or looking to expand globally on Stephen's comments?
I was in the US in January and at a fintech conference, and I think one of the themes that came out to me was that a lot of those companies raised in 2021 and haven't raised since, and so their messaging was more all around profitable growth and growing into their TAM, and in their mind, their TAM in North America is large enough. I think in Australia we don't necessarily have that benefit. We do need to go out into the global markets for certain industry or for most industries. So I think that was one interesting thing, was a lot of them were not interested in M&A by expansion globally. But that said, we're also seeing in our portfolio companies that are arbitraging the valuation discrepancy to make bids into our companies. And so that's actually one trend that we might be seeing. There might be more offshore buyers that looking to add to the product mix or customer base through acquiring companies here in Australia, and that could be an exit pathway.
I mean, for us, our companies are always targeting the US as the first market. The Australian market, we are small in population, but the price is also very low. So I've never looked at a company saying we're going to get Australian approval first and then look to go overseas. Always US approval. And the company that we mentioned, our previous portfolio company, Neuron, has had FDA approval for 2 years now almost, and still not approved in Australia. Because it's not easy to get approved in Australia, and the actual prize for getting approval is not big. And so, yeah, that's the kind of sad part about it, unfortunately. I feel like I'm being very negative. I'm going to be more positive in my next answer.
We'll try and make it more uplifting. Raj, I'll go to you. You might dip deep down into the tech sector, actually. So in 2024, for the first time in a long while, there wasn't a tech IPO in the top 10 IPOs globally. And ASX saw a similar trend. In the follow-on space, that was very strong. NextDC led the way, and the tech sector on ASX raised over $5.5 billion last year in follow-on capital, and the highest performing sector across all sectors on the market. So Raj, just given some of that, what's your outlook for the technology sector and tech businesses that you're working with at the moment, and any particular exciting opportunities that you're expecting this year?
All opportunities are exciting, Kate, but I think there's been a hiatus of IPOs, as Kate has alluded to, and most of you would have read. To give you some data, in calendar 2021, there were 257 IPOs that took place on the ASX. Last year was a 10-year low. There were less than 30 that went public, and there were none that were in technology. Digicom, that was late.
A
REIT.
REIT.
Correct, it was a REIT.
Technology
So
focused.
there's been nothing. So in our portfolio, there are 3 companies that have been mandated to go public this year, so we're excited for that. But the profile of those companies is very different to what it was in calendar 2021. So one of our companies is generating close to $500 million of revenue and is quite profitable. That is the shape of what these assets will look like in the first phase of going public. As I mentioned in one of the questions earlier, liquidity is critical. You can get liquidity in private markets. It is very difficult. You can get liquidity with public markets. It's also difficult. But what is important in public markets is if you are committed to it, if you are the right size and you are well received, it's the secondary capital that you can raise, which is astronomical. So last year, $5.5–6 billion was raised in secondary capital on listed markets. The average that was raised was $40 million across all the companies that raised. In private markets in Australia last year, less than 10 companies raised more than that amount. So it shows you that the paradigm shift towards public does make sense. There is hesitation, but that hesitation has got to abate. But the company's got to want it and the board's got to support it, because ultimately you'll raise a lot more money.
Thanks, Raj. Hashan, I might move to you next. So can't have a panel without mentioning AI. Just interested in your perspectives on AI, particularly in the life sciences sector that you're obviously focused on. How do you think it's impacting life sciences companies and at what different stages particularly?
Yeah, so there's two, I guess, broad buckets. The first one is AI to make drug development or medical device development easier. And the other is AI or software as a medical device to actually be used by a patient for whatever reason. So in the drug development side, AI can potentially speed up all of the preclinical, so before it gets into even animals. So what we're talking about is the basic, categorizing a target. Like, what does a receptor look like? Where are the binding sites? What do you want to do with that receptor? When you target that receptor, what happens in the cascade, et cetera, et cetera. And then also designing the drug, so the drug looks like a certain way. And you can do these. You used to be able to do it, but it was a bit cumbersome. You can do it a lot better now. It's called in silico high throughput drug screening. In silico just means in a computer. I don't know why in the healthcare space we've got to use different words. We just say in the computer. And they can do that very quickly. But does that really add a huge amount of value? We haven't seen it yet. So what has been the bottleneck in getting a drug to a patient has been the clinical trials, funding the clinical trials, recruiting the clinical trials. Designing the drugs has not really been the bottleneck, right? So if you go to any university in the world, there are thousands of drug candidates sitting on the shelf. And so inherently, AI in that drug development space hasn't really made too much of an impact just yet, unless there is a researcher that has a great idea and he's going to use AI to help him get that idea to a drug very quickly. In the clinical trial space, people talked about AI helping to match a patient with a clinical trial to speed up clinical trial recruitment, because that was the slowest part of running a clinical trial. AI is not really necessary in that, right? We're talking about matching a fixed protocol, which is the clinical trial protocol, with a fixed protocol, which is the patient, right? So you don't really need some genius whiz-bang AI to do that, right? Basic computer program could do that. But what we found once these products have been launched is clinical trial recruitment is very personal and very, very slow. Like the physician has to have your clinical trial in the top of their mind, has to make that recommendation to you as a patient, has to tell you why, effectively sell it to you, and then get you. And then once you're in, you have to be handheld through that clinical trial onboarding process. Because if you make a single mistake, then you're out of the clinical trial, right? And so AI hasn't really helped there either. Now we talk about AI as a product, software as a medical device. It has been unsuccessful, right? So the beachhead, or the first place where AI was going to disrupt, was diagnostic imaging, right? So reading an X-ray, reading a CT scan, reading an MRI. Now, I personally believe that the algorithms that we've got now can do as good a job, if not a better job, than a radiologist. But how do you prove that, right? So if a radiologist says there's no tumor there, but the AI says there is, the only way you can, what is ground truth in that trial? You have to cut the patient open, right? And you cannot do, no ethics committee in the world would let you do that, right? So the FDA has declared, has ruled a line in the sand, that what the radiologist sees in that image is the ground truth. So if the AI disagrees with it, the AI is wrong, right? So with that kind of a regulatory framework, how can you disintermediate the physician? How can you get rid, the only way that this is going to be commercially successful is if an AI can get FDA clearance to be able to read a CT scan without a radiologist. Because if the radiologist still has to read the scan, there's no value there, right? And similarly, a lot of the work that physicians do now is basic pattern recognition. I think AI can do a better job of that. Not really talking about replacing the physician, but we're talking about supplementing the physician, because there's always going to be a shortage of healthcare practitioners. So why can't a lot of the work that is being done now by the physician be automated through AI and only get kicked up to the physician if required? The bottleneck there is not the technology. The bottleneck there is regulatory. And unfortunately, the lobby groups that are lobbying for the physicians are lobbying against it, because, change is scary and could mean less money in the, and so that's what's really holding back AI as a product, not the technology, but the change in the regulatory and the way that we pay for healthcare. That was also negative, wasn't it? God damn it.
I'll try not lift it again, actually. Thank you.
Then I'd probably just add that I think at the more early stage VC investing side, from what I hear from my peers, there's definitely a lot of activity in AI applications that are sort of on top of these large language models. And this is actually it's sort of materialising in closed deals, which a lot of have not yet actually been announced yet. So there's definitely a lot of focus, a lot of deal hunting in this space here in Australia. And then at the later stage, we're probably seeing more about how are our companies fending off the AI disruption, as well as what strategy do they have around AI more generally. And how about you, Stephen, on the global side?
Yeah, I think for AI, definitely is a hot sector. So everyone talk about AI on different angle, pure AI or AI plus. What we see is, I think in the after the DeepSeek come out, it's a lot of I think reasonableness and rethinking about what AI really is and how that application to the industry and what's the cost. Is that the big boys, kind of games, or kind of like startup can have a piece of cake. I think from the investor side, it's come to more realistic to ask what exactly the enterprise adoption or monetization pathway is more critical to how we evaluate the AI, the business or the investment opportunities, not just kind of you put AI there, kind of like you really have an AI application. So I think to the founders is important is really what's your value proposition, your technology application there to demonstrate you really are AI or AI plus, or what exactly you can monetize the opportunity.
Actually, I do have a positive, sorry, I just thought about it. So one of our portfolio companies, what they're doing is they're working with oncologists. The oncologist resects a tumor from a patient. They can get that patient-derived model and 3D print little micro tumors into 84 well plates. And into those many plates, they can run a high throughput drug screen with different types of combinations of drugs. Because the way oncology is treated at the moment, you have different lines, different combinations, and the permutations can sometimes be in the millions, right? And so they can run those millions of permutations in this mini 3D printed 3D organoid effectively, and then use an AI imaging model to then come back to the oncologist with a suggested treatment protocol. This patient's tumor does not respond to treatment combination X, does respond to combination Y, and so that because that's all within the approved, they're not a diagnostic aid. They're just helping they're not a diagnostic. They're a diagnostic aid. So that can help. At the moment, the way that patients' cancers are normally treated is it's very regimented. They get you need to take this course first. You fail that. You take that course. You fail that. Whereas this can go, this patient's tumor was most likely to respond to this combination of chemotherapies or immunotherapies or cell therapy, whatever it might be. And so trying to bring a bit more value-based care into the way cancers are treated. And that I think is very positive.
In our opinion, 7 or 8 years ago, blockchain became much more public, and it became a protocol and people built businesses of it. In our opinion, AI is not dissimilar. People will build great businesses of it. However, when OpenAI launched ChatGPT in late 23, we saw a lot of businesses in calendar 2024 that were talking about AI, and the application that's been most pervasive has been around cost reduction and efficiency. There have been very few companies that we've seen, and we probably see 400 or 500 companies a year, that are genuine AI companies that help you generate incremental revenue. Most of them are still very much, in our opinion, around cost reduction and efficiency, but that will change. It's just it's a natural evolution. I'd also add the M&A that's taken place in AI in the last 12 months. It's been companies that want to buy products that also make them more efficient. So that, in many ways, does agree with what I said about it being an efficiency cost measure at this point, but that will change.
Thanks, everyone. I think we're running up against time, so we might just wrap up with one last question for the panel. Just interested in what you think is the greatest opportunity and the greatest challenge that we'll see in the private markets this year, and any outlooks for the market or your portfolio companies for the remainder of the year.
Yeah, I think I'll take a positive attitude here. I think it's 2025 is a transition year. We are still very optimistic about the opportunity ahead. I think the areas as what we seeing or focus on as AI is definitely one sector, but the other sector where we see strong opportunity is about the sustainability. So include climate tech, include clean tech, and how we can resolve our waste globally. So that's the area we see the opportunity there. I think for the early stage companies, I still have a lot more capital to support. What we see is a very active market in both regions. I think for the later stage, a little bit of challenge there because the valuation, the liquidity requirement, other factors in there. So, but we see if you can demonstrate, your capital, your efficiency, and your strong fundamental, like sustainable revenue models, profitability, I think you have a very bright future. At least, late 2025 and 2026. So we are very, positive about the trend.
I might just take a different angle here. I think one of the greatest opportunities this year is companies working with their investors to, manufacture potential outcomes, which could be an exit event or growth through merging with other businesses or even pivoting. So I think there is opportunity through that change. And I think one of the challenges for managers like myself would be, when would be the right time to exit? And so going on the same theme about being measured, we may need to actually deliver that liquidity and exit a bit earlier, but then continue to back those companies in other ways.
I think the thing that I'm most excited about is valuations. So like you mentioned, Karen, the valuations have come down. The gap between what a fund manager is willing to pay and what the company wants is closed, I think. So I think right now is really an amazing time to deploy capital, at least in what I can speak to in healthcare. The challenge, unfortunately, is getting that capital to be able to invest. So our LPs, they're not getting the exits from the funds they invested in, and so they don't have much capital left to invest in new funds. And on the other side of it as well is we need to syndicate, because we haven't been able to raise as much as we'd like. We have to syndicate, and then having to find that capital to syndicate on deals, that's a challenge. So we can find companies that we're very excited about. Valuation is incredible, but then it's just getting that deal over the line that is a challenge.
I think the opportunity in our mind has been going public, which has been very difficult for the last 3 years. But the reality is Australian technology companies are the most expensive in the world, and the reason is there's a dearth of assets. And to give you an idea, there are multiple technology companies in Australia that generate more than $1 billion. WiseTech does, Seek does, Xero does, and there's others. And they have astronomical valuations because everyone wants to own them, and many people do institutionally and retail as well. In private markets in Australia, it's very romantic to be involved in a private Australian tech company, but there's only 2 that generate above $1 billion, and neither of them are as expensive as the assets are that are public. So in our mind, going public does make sense. It's hard, but based on what Karen was saying earlier, and she alluded to ASIC, I think private market scrutiny will get hard. The ASX is difficult to list on, but it's always had the scrutiny. You've got to live with scrutiny.
Thanks, everyone. Thanks, Raj. Yes, we're definitely up against time now, so just wanted to thank all the panelists for your insights. I think we could chat about this all day, but we must hand back to Bella now. So thank you, everyone.
Thank you.